Welcome back to the channel. Today we're talking about SCHD. We're going to do some analysis compared to the SPY, the triple Qs, see if it's something that we should be considering for our portfolios. There's a lot going around about SCHD this year, that it's underperformed the market. I've seen a few articles that people aren't recommending it anymore. There's tons of people online that say it's a great retirement portfolio for long-term growth and dividend income. But really, we got to dive in, get to the bottom of this. All right, so I got SCHD pulled up here. This is the Schwab US Dividend Equity ETF, and this is how it looks on Schwab. Of course, the portfolio breakdown here is on the right. You can see it's different from the triple Qs in the SPY in the sector weighting. So IT, information technology, falls into 5th place, only a 12.69% weight. It's more evenly distributed. And the top 4 are industrials, healthcare, financials, and consumer staples. Looking at the SPY, we can see that information technology is at 28.2%, so it's much higher. And then you get the healthcare, financials, consumer discretionary, communication services underneath. And so, again, much higher weight on the information technology piece. Now, the triple Qs go even one step further. The informational technology section there is 49.41%, so it's really tech heavy. So here we can see the top 10 holdings on SCHD. You can look at them here on the left side. As you can tell, these are primarily value companies. The percent of assets are listed here, so they're all around the high 3s to mid 4% range. So now we're comparing to the top 10 holdings in the SPY, and here you see it's a lot more tech heavy. You're seeing Apple, Microsoft, Amazon, Nvidia, Google, Tesla, Meta. Really, those top 8 are really heavily weighted, and particularly the top 2 you see with Apple and Microsoft making up over 13% of the index. Moving over to the triple Qs, now of course the SPY is supposed to track the S&P 500, so 500 stocks. The triple Qs is the NASDAQ 100. So you get a similar top 10 list as what you had in the SPY. A couple changes at the bottom, but the weighting is even higher here. Apple and Microsoft, the top 2, are holding over 20% of the weighting in the triple Qs. Now, obviously, all 3 of these are large, liquid, highly traded ETFs, but a couple other pieces we want to look at are the alpha and the beta. So the beta is indicating volatility, and the alpha is indicating risk-adjusted return. So this is the SCHD. You can see on the right side of the screen that the beta is 0.82, indicating that it has lower volatility compared to the S&P 500. Alpha of 3.75 indicates that it actually is having a higher risk-adjusted return relative to the S&P 500. We don't really need to do the SPY because that tracks the S&P 500, so that's pretty neutral. So here's the triple Qs, and the beta here is 1.16, indicating a higher level of volatility relative to the S&P 500. And the alpha, which I should comment that the alpha here is tracked over a 3-year period. So over the last 3 years, the risk-adjusted rate of return on the triple Qs is actually negative. Now here we have a graph performance over the last 10 years that includes the SCHD, SPY, triple Qs, and the Dow Jones Industrial Average. Now the Dow Jones isn't really well liked among newer investors, but I'm using it here for a specific reason, which I'll get into in a little bit. If you look strictly at this graph, you could see that the orange line on the top is the triple Qs, and you'd say to yourself, wow, it's really outperformed. This is such an easy answer. Why don't we just buy the triple Qs? I'm going to get into that a little bit and explain why I think SCHD should be considered as a piece of everyone's portfolio in order to manage risk moving forward. A key here is that the graph doesn't reflect distributions, capital gains, sales loads, redemption fees, or effects of taxes on distributions. So as we move down here, now we're looking at performance over specific periods of time that include dividend reinvestment, capital gains, consideration for loading fees, expense ratios, etc. So this is an adjusted rate of return. Now, going back to look at this, you can see that the triple Qs have outperformed by a large margin this year. But these are ETFs that I think a lot of people should consider for the long term. So we're going to scroll all the way down to the 10-year period and compare those to start with. Now, SCHD is just under 12%, while SPY is almost 13%. The triple Qs is 18.5%, and the Dow Jones is 11.27%. So if you say to yourself there, well, the triple Qs have outperformed over a 10-year period, again, why are we even going over this? Definitely should consider the triple Qs. However, just wait 1 minute, because if we go down to the inception date, you can actually see that SCHD has outperformed. Well, SCHD has only been around since 2011, but since its inception, it has outperformed the SPY, the triple Qs, and the Dow Jones. The triple Qs are only 9.21% annualized return since inception, which is 1999. And I'm guessing you can have an idea of why that might be. You're dealing with the dot-com bust and the great financial crisis in that period. So the triple Qs haven't always returned as well as they have over the last 10 years or so. One thing we want to consider is, what's the future look like? What's the next 5 to 10 years look like with the stock market? And we're going to dive in here and look at how the triple Qs and the SPY compared to the Dow Jones from the inception of each individual's ETF. The reason being is that the last 10 or 12 years, since the great financial crisis, we've been in a low interest rate environment and a high growth environment. Since the triple Qs really push hard on growth, technology, with low interest rates, you see substantial returns over that time period. So anyone who's been in the triple Qs since then has really outperformed the market and has done very well for themselves. But with interest rate hikes, perhaps a slowing economy, more value-driven economy, moving forward, as a potential, the triple Qs may not perform as well over the next 5 to 10 years as they have over the last 10 years. And we're going to dive into that right now. So what I've done here is I've pulled up on TradingView the triple Qs, which is the time period from its inception up until the time that SCHD ETF was started. And that's October 2011. So here we're talking about 12 years or so. And as you can see, obviously these are estimate numbers, but the triple Qs only performed a gain of 13.21% over a 12-year period. Now keep in mind the expense ratio of 0.2 is going to be much higher than the SCHD, which is 0.06, and the dividend is very low, and we'll look at that right now. So here you can see for the triple Qs, the distribution is yield, and yield has been pretty consistent over time. And the current distribution yield is 0.57% with a 30-day yield of 0.63%. Now we compare it to SCHD, which again has had fairly consistent dividend payments over time, with a current yield of 3.49% and a 30-day yield of 3.57%. So you're talking around 4 to 5 times greater dividend payouts with SCHD. The SPY falls a little bit in the middle with the dividend of 1.45. Now SCHD is the dividend Dow Jones 100. It's not obviously going to track the Dow Jones Industrial Average, but it can trade somewhat similarly as we saw in the comparison chart. So I don't have the ability to take SCHD back prior to 2011. So what we can do is we can compare the Dow Jones Industrial Average and use it as a substitute for what SCHD may have done or how it may have similarly performed during these prior time periods. And here we're looking at the Dow Jones Industrial Average from March of 1999 through October 2011, the same time period of the triple Qs. And we can see here that the actual return is more than double of what we saw with the triple Qs at 27%. And this obviously is not including the dividend yield. So you're going to have 12 years of compounding dividend yield on top of that. So the actual return would be much higher. Now the SPY, which is the ETF for the S&P 500, goes back even further to around 1993. When we look at that since inception until the October 2011 time period, it had a much better return than the triple Qs, primarily because it was starting at a lower level back in the early 90s, but it had a 184% return over that time period. And we can see here now that the Dow Jones actually outperformed quite a bit from the SPY at 255%. In addition, again, you're getting the dividend yield with the Dow Jones. So what's the bottom line? At the end of the day, it all depends on how the markets respond and how they react over the next 5 to 10 year period. If we continue to get growth, we continue to get PE expansion with high-tech driven markets, the triple Qs are likely going to continue to outperform even without having a strong dividend payment. If we're in a value type environment, low growth environment, then I could see SCHD potentially outperforming the triple Qs in the next 5 to 10 years. What you get with the SCHD is that you have lower volatility and you get that recurring dividend payment. So if that's something you're interested in, it certainly could be a good option for anyone's portfolio. If you're towards the end of your investing career or you want to preserve capital, that's probably going to be a safer and better bet over the next 5 to 10 years. If you're young, you're energetic, you're willing to take risk, then the triple Qs might be something that's more appealing to you. Me personally, I'm going to invest in both. Divide and conquer, diversify. The holdings in each ETF are quite different, and it gives you more diversity in different market settings. And that for me is going to be my best option. But of course, you got to choose what works best for you. And I hope you found this video informative. If you liked it and you enjoyed the content, please subscribe, hit the like button, shoot me a comment down below, let me know what your thoughts are, and we'll see you in the next video.